During your working years, your tax rate steps up gradually along a predictable linear staircase. But the moment you retire, that staircase shatters. Your withdrawals create a jagged curve where a single additional dollar triggers cascading penalties, pushing your tax rate to 50%. We have to separate the nominal tax bracket, the percentage the IRS prints on its official tables, from your actual effective marginal tax rate. The effective rate measures exactly how much of your next dollar is lost to taxes, evaporating deductions, and hidden surcharges. To navigate this, we are going to map the true topography of retirement taxation, layer by layer, so you can see exactly where these traps are buried. If you plan your retirement withdrawals trying to simply stay just beneath a nominal 22 or 24% bracket, you are actively draining your net wealth. The progressive linear model is useless here. Instead, real-world retirement liabilities are dictated by intersecting phase-outs and discrete cliffs that the nominal brackets ignore entirely. Let's start with a blank coordinate plane and map the first massive spike, the Social Security cascade. The IRS decides whether your Social Security is taxable using a gateway metric called provisional income. You calculate this by adding your adjusted gross income, any non-taxable interest, and exactly 50% of your Social Security benefits. If you are single, your benefits are tax-free until that provisional income hits $25,000. Above that, up to 50% becomes taxable. Cross $34,000 and up to 85% is taxed. Those thresholds have remained completely static since they were written into law in 1993. Consider a single taxpayer in the 12% nominal bracket. They need cash and decide to withdraw exactly $1,000 from their IRA. That withdrawal generates a straightforward baseline tax of $120. On the IRS Social Security Benefits worksheet, the $1,000 withdrawal inflates provisional income, pushing $850 of protected benefits through the 85% multiplier. In the 12% bracket, taxing this exposed amount adds exactly $102 to their IRS bill. Third, the inflated AGI pushes a block of previously tax-free capital gains into the 15% bracket for $150 in tax. But finally, the newly taxable Social Security benefits push still more of those gains into that same 15% bracket, triggering another $127.50 in tax. The original $120 tax, the $102 Social Security tax, and the combined $277.50 in capital gains taxes sum to $499.50. The $1,000 withdrawal created an effective marginal tax rate of 49.95%. Accessing a single dollar of retirement savings acts as a multiplier, inflicting massive collateral damage on income streams you thought were secure. Pensions do not receive the preferential threshold exclusions granted to Social Security. Every taxable dollar of a pension flows directly into your adjusted gross income. It acts as the primary lever forcing provisional income past the Social Security taxation limits. Administering that pension creates an immediate trap through a specific IRS document, Form W-4P. If you do not actively submit this form, the law requires your pension payer to use a rigid default setting, withholding taxes as if you are a single filer with zero adjustments. If you are married, or if you qualify for the OBBAA Senior Standard Deduction, which adds a $6,000 bonus, this default setting calculates your tax liability with severe inaccuracy. Relying on the default means your pension payer will either massively overwithhold, giving the government an interest-free loan from your cash flow, or severely underwithhold, triggering an IRS penalty for failing to pay enough throughout the year. Leaving your pension withholding on autopilot ensures a cash flow drain today or a surprise tax bill in April. The topography is also shaped by deduction phase-outs. The age 65-plus bonus deduction phases out at $75,000 of adjusted gross income for singles and $150,000 for married couples filing jointly. If a married couple sitting in the 22% nominal bracket takes exactly $1 of distribution above that $150,000 line, they trigger the phase-out math. Earning that dollar forces them to forfeit 12 cents of their bonus deduction. They pay 22% on the new dollar, plus 22% on the 12 cents of lost deduction. Their actual effective marginal rate steps up to 24.64%. These subtle phase-outs operate as stealth multipliers. They silently extract wealth from retirees who believe their nominal tax bracket protects them. The IRS uses continuous formulas, but Medicare relies on discrete binary cliffs, known as the Income-Related Monthly Adjustment Amount, or IRMAA. This table maps the 2026 IRMAA tier boundaries. For a married couple, the Tier 1 line sits at $218,000 of MAGI. Hitting $218,001 triggers an absolute penalty, a $2,297 annual Medicare surcharge for the couple. Mathematically, crossing that boundary imposes an infinite marginal tax rate on that specific $218,001 dollar. This cliff is governed by a temporal trap, the 2-year lookback rule. Medicare uses the tax return you filed 2 years ago to determine today's premiums. The modified adjusted gross income you generate right now permanently locks in your absolute Medicare penalty costs 2 years downstream. IRMAA transforms tax planning into time travel planning. You have to restrict your income and optimize your withdrawals 24 months before the penalty can actually hit you. The most severe topographical shift happens when a spouse dies. The survivor is legally forced to transition from married filing jointly to single filing status. Instantly, the standard deduction and bracket thresholds are sliced in half. A household earning $200,000 might sit in a safe valley while married, but when the survivor maintains that exact same income, they slam directly into the compressed tax spikes and IRMAA crufts. The survivor's actual wealth has not increased, but the asymmetry of the tax code causes their effective tax rate to skyrocket and their IRMAA surcharges to double. Building a strategy based on a permanent married filing jointly reality while ignoring the inevitable shift to single filer status is a devastating mathematical error. We'll now pivot from mapping the danger to executing defensive operations designed to mathematically flatten the curve. The first tactic is the Qualified Charitable Distribution, or QCD. Under the new OBBBA rules, itemizing deductions is harder, but a QCD satisfies your required minimum distributions entirely below the line. The capital moves directly to the charity, meaning it never touches your adjusted gross income and never triggers IRMAA. The second tactic is executing Roth conversions strictly within the golden window. The golden window occurs between ages 60 and 62. By aggressively converting tax-deferred volume into Roth accounts during this specific time frame, you permanently eliminate future RMDs before the age 63 IRMAA lookback period even begins. The third tactic applies to lump sum pensions. You execute a direct rollover, moving the capital straight from the pension plan to an IRA. By bypassing your personal bank account entirely, you neutralize the mandatory 20% federal withholding trap. This chart demonstrates the result. Deploying these tools mathematically flattens the extreme spikes into a manageable, predictable slope. True retirement planning requires you to abandon the illusion of linear brackets.